Three things happened in the same week. On Monday, the U.S. government launched a portal to begin refunding $166 billion in tariffs that the Supreme Court ruled unconstitutional in February. Over 330,000 importers across 53 million shipments are eligible. It's the largest repayment to businesses in American trade history, and when that money flows back into the economy, it functions as stimulus. The same week, Brent crude oil settled near $98 a barrel after the U.S. Navy imposed a blockade on Iranian ports following failed negotiations in Pakistan. The Strait of Hormuz, which this series covered in Video 20, remains functionally disrupted. Oil near $100 is inflationary pressure that touches every consumer, every business, and every transportation cost in the supply chain. And on the same day, the leading candidate for the next Federal Reserve chair testified before the Senate and signaled a hawkish posture, suggesting that rate cuts are unlikely before December and that the Fed sees elevated asset prices and persistent services inflation as reasons to keep monetary policy tight. Three forces, one stimulative, one inflationary, one restrictive, all arriving simultaneously, all pulling the economy in different directions. Every news channel will cover each one separately. Nobody is mapping the collision. That's this video. I'm Warren. The architecture built across 26 videos was designed for uncertainty. Today's uncertainty has a specific shape, three vectors that contradict each other, creating a market environment where the usual narratives break down and the person who tries to trade the headlines will be wrong in at least one direction at all times. Force 1, the tariff refund. $166 billion sounds abstract. Here's what it means in practice. American importers, from small businesses selling backpacks to multinational corporations importing components, paid tariffs on goods brought into the United States under emergency powers that the Supreme Court later declared unconstitutional. Those tariffs functioned as a tax. They raised costs for businesses, which passed those costs to consumers through higher prices. The refund reverses that tax for businesses, though not directly for consumers. When businesses receive the refund, several things happen. Cash flow improves. Some businesses will reinvest, some will hire. Some will reduce prices to regain market share lost during the tariff period. The aggregate effect is stimulative, $166 billion re-entering the economy over the next 60 to 90 days as refunds are processed. For the person holding VTY, this is broadly positive. Corporate earnings for companies that import goods should improve as the tariff cost disappears from their expense line. Retail stocks, consumer discretionary, and industrial companies with complex supply chains are the direct beneficiaries. These sectors are all components of VTI. The index captures the upside without the person needing to pick which specific company benefits most. If you've been following the news about the tariff refund and wondering whether it affects the portfolio from Video 10, the answer is yes, indirectly and positively. The earnings of the companies inside VT1 improve when their costs decrease. Better earnings lead to higher stock valuations over time. The refund doesn't show up in the Fidelity app as a deposit. It shows up over the next 2 to 4 quarters as improved corporate margins, revised earnings guidance, and a slightly more favorable environment for the companies the index holds. The person who owns VTI participates in that improvement automatically, the same way they participated in every other macroeconomic shift across this series, by holding the entire market and letting the index do the work. There's a second-order effect worth noting. The tariff refund puts cash back into the hands of small businesses, many of which were the most severely impacted by the tariffs. According to court filings, over 330,000 importers are eligible. The majority of those are small and mid-sized businesses. When those businesses receive refunds, some will use the cash to rebuild inventory, hire workers they couldn't afford during the tariff period, or pay down debt accumulated to cover tariff costs. That's economic activity that creates jobs, increases consumer spending, and feeds back into corporate earnings. The refund isn't just a one-time cash injection. It's a catalyst for a recovery cycle in the parts of the economy that were most damaged by the tariffs. But the stimulus arrives into an economy that's already dealing with the second force. Force 2, oil at $98. The Iran situation has been evolving for weeks, but the naval blockade that took effect in mid-April created a new level of supply disruption. Brent crude briefly crossed $100 before settling near 98. The Strait of Hormuz carries roughly 20% of the world's oil supply. While the blockade targets Iranian ports specifically and doesn't impede non-Iranian vessels, the risk premium on every barrel moving through the region has spiked. Insurance costs for tankers have risen, shipping routes are being rerouted, and the market is pricing in the possibility that the disruption lasts months rather than weeks. Oil at $98 is inflationary, not the kind of inflation that shows up in a single month's CPI print. The kind that seeps into every cost structure in the economy. Transportation costs rise. Manufacturing input costs rise. Food prices rise because agriculture depends on fuel. Airline tickets rise. Heating costs rise, and all of that arrives at the consumer level while cumulative inflation since 2020 already sits above 25%. The consumer, already stretched, gets stretched further. Credit card debt, already at a record $1.28 trillion, grows faster as households borrow to cover the incremental cost. If you hold VXUS, the international portion of the portfolio, oil at 98 affects the countries that import energy more than the countries that produce it. Asian economies, heavily represented in VXUS, are disproportionately exposed to energy price spikes, as video 20 explained. The same dynamic from that video is playing out now in real numbers. China imports 11 million barrels a day. Japan, South Korea, and India are all net importers. When oil rises 25% in a month, the drag on those economies shows up in VXUS within 1 to 2 quarters. But here's the counterbalance that also lives inside the portfolio. VTY includes American energy companies. When Brent hits 98, Exxon, Chevron, ConocoPhillips, and the pipeline operators inside VTY see their earnings spike. The energy sector's weighting in VTY is roughly 4 to 5%. During an oil shock, that 4 to 5% outperforms significantly, partially offsetting the drag on consumer-facing sectors within VT1 and the drag on international equities within VXUS. The portfolio doesn't eliminate the impact of $98 oil. It distributes the impact across sectors and geographies so that no single shock dominates the total return. That's diversification doing its job in real time. If you filled up a car this week and noticed the price was higher than a month ago, that's the second force arriving at your level. The macro event in the Strait of Hormuz shows up at the gas pump within days. The portfolio impact takes longer to materialize but moves in the same direction. The paradox of forces 1 and 2 arriving simultaneously is this. The tariff refund pushes money into the economy while oil prices pull purchasing power out. One hand gives, the other takes. The net effect on the consumer depends on which force is larger and which arrives faster. The refunds will take 60 to 90 days to process. The oil price increase is immediate. In the short term, inflation wins. In the medium term, the refund partially offsets it. If you're a consumer right now, the experience is dissonance. Things are getting better and worse at the same time. That feeling is accurate. Both things are happening. Force 3. The hawkish Fed. In a normal environment, the Federal Reserve would respond to an oil shock by considering rate cuts to cushion the economic impact. But this isn't a normal environment. Inflation, driven partly by the oil spike and partly by persistent services inflation, is running above the 2% target. The Fed's incoming leadership has signaled that rate cuts are not imminent. The current projection, supported by Deloitte's first quarter forecast, is that the Fed holds rates steady through at least December 2026. That means mortgage rates, which are anchored to long-term Treasury yields as video 19 explained, stay elevated. If you've been waiting for mortgage rates to drop back toward 4 or 5% before buying a house, the hawkish Fed is the force that keeps that from happening. The math from video 14, the $500,000 house at 6.25%, remains the operative math. The rate hasn't changed because the Fed hasn't changed. And the Fed hasn't changed because inflation hasn't cooperated. Corporate borrowing costs stay high. The stimulative effect of the tariff refund is partially neutralized by the cost of money remaining expensive. For the bond allocation in the portfolio, BND, the hawkish Fed creates a specific dynamic. When rates stay high, existing bond prices remain suppressed. BND doesn't rally the way it would in a rate-cutting environment, but it continues paying yield, which is reinvested automatically. And in a stressed environment where equities may be volatile, the bond allocation serves its primary function, dampening overall portfolio volatility. BND doesn't need to rally to do its job. It needs to not fall as much as equities during a drawdown. And in an environment where the Fed is holding rates rather than raising them, BND is stable rather than declining. Stable is sufficient. Here's where the three forces collide in a way that matters most for the person following the protocol from video 24. The tariff refund is bullish for corporate earnings in VTI. Oil at 98 is bearish for consumer spending and international equities in VXUS. The hawkish Fed is neutral to slightly negative for bonds in BND and negative for growth stocks in VTY. Three forces. Three different effects on three different components of the portfolio. And the diversified portfolio absorbs all three simultaneously because that's what diversification does. It doesn't optimize for any single outcome. It survives all of them. The person who tries to trade these three forces, selling VXUS because of oil, buying energy stocks because of the Iran premium, shorting bonds because of the hawkish Fed, is making three bets simultaneously in three different directions with three different time horizons. One of those bets will be right. Two will likely be wrong. And the transaction costs, tax implications, and behavioral stress of managing three active positions will erode returns even if all three bets happen to be correct. The index investor who follows the protocol makes 0 trades, checks the transfer, tracks the number, declines the offers, names the milestone, does nothing to the portfolio, and the portfolio absorbs the collision the way it was designed to, through diversification, automatic contribution, and time. If you're watching these three forces unfold and feeling the urge to do something, that urge is the same one from every threat video in this series. The Japan carry trade, the oil crisis, the hidden recession, the bank clauses. Each one created an urge to react. Each time, the correct response was the same. Continue the protocol. The forces are real. The collision is real. The portfolio was built for exactly this kind of complexity. And the person who trusts the architecture through the collision is the person who compounds through it. The three-force collision also reveals something about why the financial media fails the average investor. Every outlet covers one force at a time. The tariff refund story is bullish. The oil story is bearish. The Fed story is cautious. Three different channels give three different recommendations depending on which force they're covering that hour. The investor who watches all three channels ends up confused because the signals contradict. And confused investors make mistakes. They sell one thing and buy another based on whichever headline arrived most recently. The index investor sidesteps this entirely. Not because they're smarter, because the portfolio holds all three scenarios simultaneously and doesn't require the person to pick which one dominates. If you've built the system from this series, the three-force week is validation, not a test. The portfolio was designed to absorb contradictions. The protocol was designed to run regardless of which headline is loudest. And the compound curve from video 15 was designed to continue bending regardless of which macroeconomic force is temporarily winning. The temporary forces cycle. The compounding doesn't. Here's the question this video leaves open. Three forces pulling in three directions create an environment where traditional predictions fail. The bullish case requires the tariff refund to overwhelm the oil shock. The bearish case requires the oil shock to overwhelm the refund, while the Fed refuses to cushion the impact. The sideways case requires all three forces to roughly cancel each other out, producing a choppy, directionless market that frustrates bulls and bears equally. Nobody knows which scenario plays out, and anyone who claims certainty is selling something. The architecture doesn't require certainty. It requires consistency. The transfer runs, the index holds all three scenarios inside it. And the compound curve, the one from video 15 that starts flat and bends and then goes vertical, doesn't care which of the three forces wins. It cares that the person doesn't stop. The collision is temporary. The compounding is permanent. And permanent always beats temporary for the person with enough time and enough patience to wait it out.